Hello, I'm Michael Kops from Heartland Advisors. Today I'm joined by Will Nasgovitz, Portfolio Manager for the Value Fund. Will, how would you describe the small cap landscape in Q1?
We saw a really strong performance, at least for small value. The Russell 2000 value index was up nearly 5%. So that's a good absolute number. The relative performance was even more impressive. The S&P 500 was down just over 4%. So quite a divergence in performance year to date thus far. So it's really quite encouraging.
Excellent. And I know there was some volatility. When we see volatility like this, how does it make you think about the portfolio and your holdings versus your watch list?
It's a great question. I think it's a balancing act of trying to keep in mind portfolio needs from like a sector industry standpoint, making sure that we're not too overweight or too underweight, understanding those risks associated with that. And when there's volatility, opportunities present themselves that help us fill a need with something that's on the watch list. But anything on the watch list has to compete with what we own today from a risk reward standpoint. So just because we think it's a really compelling opportunity, we need to balance that relative to what we own today. Maybe it just makes more sense to add to something that's been beaten up in this volatility perhaps that we saw in the first quarter versus adding a new name.
Sure. So how helpful is it for you to have the 4 price targets kind of at your fingertips when these moments arise?
It's super helpful. For us, it comes down to expectations. You came into the year, everyone thought the Fed would be cutting rates. We talked about that probably as a catalyst for small cap stocks last quarter, or maybe even for this podcast. And that's completely changed, right? We don't control that. We don't know how it's all going to play out throughout the rest of the year, but the price targets help us calibrate that risk. And I think it helps us to think about, the risk reward in terms of the upside and the downside. And when we get to those moments of extreme volatility, to look at the needs of the portfolio and say, well, this skews a lot better based on our risk reward. Let's add to this versus adding to something else.
Yeah, it's interesting. I hear you talk about it a lot amongst the team. And it's when you have these moments come along, like you said, maybe 6 months ago, the skews looked a certain way for some range of outcomes.
Mm-hmm.
And now that subset of outcomes is totally different than what you thought it was going to be, but you still have all these range of outcomes built in. Was there an example in the quarter where you were able to take action on anything based on that information?
And nothing really jumps out to me right now. I mean, we had some ads in the portfolio where we've been trying to focus on building some of those smaller positions.
Okay.
Right. That we want to get to minimum like 50 basis point positions. And the volatility and the downdraft that we saw associated with the conflict in Iran, or if it's, that it's certainly associated with AI and what that was doing to some businesses, allowed for us to build those positions up to more of that appropriate level. But nothing specific really stands out to me in terms of
like a big change.
Right. Yeah.
Yeah. Got it. Understood. Well, there was a nice outperformance for the quarter. The fund picked up 7.35% versus just under 5%, as you mentioned, for the benchmark. So now you have a solid quarter, which, we try not to get hung up on the short term, but here we are reporting how the quarter went.
Right.
But we also, of course, want to think about the long term, but over kind of most of the meaningful, measurable timeframes, you're beating. So it's a lot to be proud of, but maybe you could share a little bit about what drove the short-term outperformance and then comment longer term.
Well, that's a good question. And there's some overlap there. We want to beat with the, by utilizing our 10 principles of value invested. That's our edge. And that we'll see that through security selection. And we saw that in Q1 here, where if you look at a sector attribution, we had positive security selection in 8 of 11 sectors. And that's what we want to do. That type of performance we've seen, on the 1, 3, 5 year basis too. And that's what we want to do going forward. And where we lagged from a security selection standpoint, the standout or the one with the black eye would be in energy. And that didn't surprise us. In the quarter, we saw a rapid appreciation in oil prices associated with the conflict. We do stress testing in the portfolio. We knew that was a risk to the portfolio. You might question, why did we not act on that? Well, we have other commodity risk in the portfolio, and we just didn't think it made sense to add additional commodity risk in the portfolio. We'll see how this all plays out. We have found some opportunities to address that need in the portfolio in terms of that underweight in energy, particularly on the energy services side, as we kicked off here in Q2, where we've been picking off some names that have lagged this rally in the group here to help mitigate that risk in the portfolio going forward. But overall, we want to continue to win with security selection, and that's really what the 10 principles of value investing does for us.
Excellent. Okay, so with that in mind, is there a specific holding that you think is interesting you'd like to share a little color?
I think one that's topical because it fits with the energy landscape is Allegiant Airlines, ticker ALGT. We've owned this in the past. We owned in the value fund going back, coming out of the great financial crisis in 2010. So it fits with an example of that institutional knowledge that we have at the organization. It was a great contributor for our shareholders back then. We've been monitoring from the periphery for well over 10 years. And we were on the sidelines on it because they diversified their business, if that's a word, where they launched the endeavor to build a hotel in Florida. It started in 2017. Running airlines hard enough. Launching a hotel in a very competitive market can be very challenging too. Then you throw in COVID into the mix and all the uncertainty associated with that. They learned from that. They moved on from that. And that was a catalyst for us to initiate a position last year. And clearly there's a headwind for them in terms of the fuel costs have gone up significantly with the rise in oil prices. Interestingly, they updated their guidance in the first quarter where they came in stronger than anticipated because demand is quite strong for them. The markets look through that because they're understanding, the need or the challenges associated with fuel. We think they'll get through that. They have a very unique model in that they operate in markets where there's not a lot of competition. The vast majority of their flights have zero nonstop competition. So they have actually a bit of a moat around their business, which is quite interesting in the airline space. So we think that they're going to navigate this fuel challenge and continue to focus on their core business and see their margins expand to in line with a competitor like Ryanair in Europe. And we could see significant multiple expansion in the story. So while it's worked for us in the near term, it's appreciated nicely. And in the face with the sell-off associated with oil, we still see a lot of upside at Allegiant longer term.
Sounds like a classic self-help example.
Right.
Yeah,
Right.
great. Okay, so what are you looking out for now as we head into Q2 and the rest of the year? What's on your mind?
I think it's similar to the prior commentary that we had here, where there's just still a lot of opportunities in some of the cyclical areas of the market that have yet to be exploited by investors because we've just been in this period of uncertainty associated on the political front, geopolitical front, interest rate front, commodity front, AI front, COVID front, et cetera. And a lot of these businesses have yet to see inflections, but it's starting to happen. You can see it some of the macroeconomic data, for instance, like the ISM, getting above 50, it's set back here most recently. But a lot of businesses that are tied to that have yet to see the market appreciation, if you will. And we're picking off those opportunities. So it's a continuation of what we talked about in the past. We're going to eventually have a broader economic cycle. And we want to be on the front of that by positioning the portfolio to capitalize on those opportunities that are screening well relative to our 10 principles.
Excellent. Any final thoughts?
No, we're excited about the opportunity set out there. We want to capitalize on the volatility that presents itself. We think we've got the game plan to do that by sticking to our knitting with the 10 principles of value invested and using those tools from a portfolio construction standpoint, a reference to stress testing around commodities, et cetera. We think that, again, is the recipe for us to win with the 10 principles.
Excellent. Thank you so much, Will.
Thank you.